Let's talk to Mike Van Dulken, Head of Research at Accendo Markets. Very good morning to you, young
Morning.
Mike. Right, 3 thought-provoking slides as always. Let's kick off with the first one, Cairn Energy, triangle consolidation. What's going to happen?
The shares are in a longer term uptrend, so we're only showing here, what have we got, 6 or 7 months worth of data, but longer term the shares are in an uptrend, hence that lower rising trend line that intersects around about 200 pence. As you say, consolidating, narrowing triangle. I think potential here for a fallback towards 230 thereabouts before likely another bounce. Whether that bounce then results in a breakout remains to be seen, but what we're trying to highlight here is that there's still potential. It doesn't look it on the chart, but potential for a 10% fall before another rise, before a bigger rise and a resumption of the uptrend. That said,
but the good thing here is if you're a technical trader, okay, basically the levels are very, very clear, aren't they? Where you should stop yourself out, okay?
Exactly.
Where you should take the profits. So that makes that decision much easier, doesn't it?
Yeah, I mean, if you were looking at trading this short, where we 247, put your stop the other side of the recent high at 254, give it some breathing room. You've still got, if you gave yourself a 3% stop distance versus the 10% downside, it's still a risk reward of north of 3.1 or thereabouts, 3.3 even. So plus if the shares want to go further south than 230, then your upside is even more. If they do bounce as expected, you can do the same in reverse. Put your stop south of where it does bounce, and you've got potential for it to rally back to the highs and on and on. So if we look at what happened back in late May into June, this pattern has happened before. You're looking for it to repeat.
Yep.
We don't try and second guess that this is going to ultimately be a breakout. It could still be a breakout, but we'd expect this, as you say, consolidation trend to continue in the very near term.
A great risk-reward trade. Okay, let's move on to Dixons Carphone. What's going on here? Big gap to be filled at some juncture?
Potentially, but it failed to do so in June. So we saw that big gap down in mid-May. That was when we found out about a huge data breach, which has subsequently been told to us it was even bigger than thought. So the shares haven't closed the gap. So for the moment, we wouldn't be expecting them to do so. For the moment, I'm seeing us in a sideways channel, 170 to £2. We're off the bottom, potential for a continuation of this bounce towards 200. That said, have we officially broken the trend of falling highs since early May? Not 100% sure, but I think if we narrow into the recent range of 170 to 200, I think there's potential for another visit of those highs. Whether thereafter we continue downwards remains to be seen. Indeed, whether we fill the gap remains to be seen.
But again, another trading idea with clear levels of...
That's it. I mean, that support level 170 has held up in early August, late July, late May, mid-March, and then it is resistance turn support if we go back to December. So it's been in play for well over half a year now. So
a really big chart point.
And the longer a support or resistance level is in play as support or resistance, the stronger it is, and especially once it is broken, we expect the bigger the move.
Understood.
The bigger move.
Okay, let's wrap up with the last slide. Persimmon.
Yeah, I think we talked about this one of the last times I was in. We were looking at a shorter time frame, maybe only the last 6, 7, 8 months. I thought I'd zoom out a bit to show the power of intersecting trend lines, so not just horizontal support or resistance, but the ones you can draw through the highs and the lows. So we've gone all the way back to March 2016. Then we had the big drop there will have been the referendum result. Then we got the highs of July, August, which we intersect then again the highs of early 17, the lows of April 17, etc., etc. And it's interesting that corresponds with the recent bounce. I should have added a zoomed in chart as well to look at that, but the recent support level horizontal around 2,400 corresponds with that intersecting, which again adds a bit of power to the support level. And Well, we've yet to see a really meaningful bounce and challenging, you know, 2,500 or thereabouts. The longer it does hold up above 2,400, the better. The better the chance that ultimately we see a continuation of the trend over the last year, which is 2,400 to 2,900.
Well, I think the important thing about that is to remind anyone watching this video is that, you know, always look at the longer term before you look at the short term in terms of old support and resistance lines. Because
something can look extremely exciting short term. You zoom out and then you see falling highs resistance or rising support you weren't aware of, which can ultimately trump whatever you were seeing, which is dangerous. Obviously, Persimmon, house builder, we are facing a slowing UK housing market. That said, this morning, the RICS house price balance was bang in line with it as expected, an improvement and a bigger improvement because the prior month was revised higher, so maybe things aren't as bad. We're still getting conflicting messages from the UK housing market, which is difficult. It's not cratering, even though the Brexit uncertainty, as your last guest said, is growing. We're still at risk of a no deal. Where will we be? Will we get more certainty back end of this year? I think the target for more major decision of October has now been pushed to by the end of November, which isn't great. You've lost another month to 6 weeks. We can't really afford that with just, at the time, it'll be 4 months to go. But for the moment, for this to be holding up so well, in the face of slowing house price data, in the face of growing Brexit uncertainty, and in the face of, again, conflicting signals from the high street in terms of consumer confidence demand, it's holding up remarkably well.
On that note, Mike, thank you very much indeed.
Thank you.